Larry, where should we begin? There is, as we were just discussing, a lot of history in this club. There's a lot of history in this building. So,
where are you going with this?
How would you characterize this moment in American history?
It's no different than anything else. We're fine. I mean, look at in our 37 years of running BlackRock, we're not focused on the day-to-day. We try to consistently talk with a narrative about long-termism, working with clients in the long run. I mean, obviously, things, when you see a 20% market decline in 3 days, obviously it has significant impacts and the ripple effects of the potential of tariffs is going to be long-standing. And so our job right now is to just be, we're having more conversations with clients. Probably the last time we had this many client conversations at BlackRock was right when we closed our economy in March of 2020. And this is the type of time where we really try to connect. We manage money for people in 106 different countries. We have offices in 36 countries. So what we need to be doing every moment is bringing all this global information that we gather with $11+ trillion of money and hearing and paying attention to the flows and where the money's going. But the magic sauce of BlackRock is the last 20% of being local and being really connected to each and every client worldwide and try to really add to them. So we're bringing all this global information, but we really try to be local in every community where we operate and work. And as a fiduciary, our job is to be helping Canadians right now. Our job is helping Europeans now. Our job is to be helping Americans now. And so, obviously markets are down 20%. So some stocks are down over 30, 40% from their high water marks of just from January. But in the long run, I would say in the long run, this is more of a buying opportunity than a selling opportunity. That doesn't mean we can't fall another 20% from here too. But I do believe over the long run, the vitality of the United States will persist. And I'm still proud in terms of working with every investor worldwide.
When you just said it doesn't mean that the market can't drop another 20%, a bit of a gasp go through the audience.
I won't like it, but it's not going to, but unlike most, like let's say 08 and 09, you don't see the leverage in the system. You don't see systemic risk. You see this is more geopolitical issues. Look, the fundamental issue that we're all trying to recognize, post-World War II, the United States was a global stabilizer. And I've been now in July will be my 49th year in finance here in New York City. And that's been one of the foundational tenets of I would say the financial community that, we live and work and grow with our economy. And one of the main foundations of the U.S. that we are a global stabilizer. Obviously, in the last week, we have not been a global stabilizer. We have, and I think that is something that is this going to persist? Are there going to be new global stabilizers in the world? Well, if there are new global stabilizers in the world, and I'm not suggesting there will be, these are questions that must be asked. What is the role of the dollar in that ecosystem? So there's a lot of questions that we need to be asking ourselves. But 80 days ago in Davos, the phrase was American exceptionalism. You heard everywhere. I would say probably every meeting I went to, everyone is focusing on how to do more in the United States. And obviously that's been thrown out right now. Obviously you can look back and say that was just irrational exuberance of too much related to the U.S. And so that we are seeing a recalibration. 75% of the market value, this was before the last few days, 75% of the market value of the global capital markets was here in the United States. Can there be a reordering of that in the short run? Maybe in the medium term? Sure. And so all of this is the type of questions. Clients have historically underweighted Europe. Okay. So far this year, that's been a bad trade. Should clients be reorienting themselves back into Europe? Should they be reoriented into more of a more broadening of a portfolio? So all these questions are being asked, and I don't have a good answer yet. But I am troubled by that we are not the stabilizer as a country. We are destabilizing, and I think this is what the financial markets are trying to grapple with.
There are, let's say, at least a couple of competing narratives. One of those narratives is from President Trump himself. He says that the tariffs he rolled out last Wednesday in the Rose Garden will create an economic renaissance and make America wealthy like never before. And then the other narrative is the public market narrative. That's the one that's telling us something altogether different, that the tariffs are an economic train wreck in the making. And if anything, they'll make not only the US, but perhaps other countries a lot poorer. Which of those narratives is right?
It's probably something in between, but as a market participant, I'm more in the market narrative. So let's be clear. In the United States right now, 8% of workers are in manufacturing. 8%. 8. So how much more should it be? 16%? I don't know, but it's not. I don't think. I looked up what the new entry level of automotive worker is today. It's about $25 an hour, $25 to $28 an hour. That's not a great job versus today. And Brad Smith, the president of Microsoft, talked about this last Monday, stating that we're going to have a shortage as large as 500,000 electricians in this country. Electricians today are paid over $150,000 a year, especially for the advanced electricians who are doing AI and all that. So there are many ways where we could create great jobs instead of this whole reordering. And so I believe the markets. I've always believed in the markets, and I believe the markets are telling you the real story. And the markets are telling that story right now. Could the story be a little too negative now? Maybe. Could it be not negative? Not maybe too. I'm not here to suggest we're over this pathway. We'll have to see how this plays out. And so we're going to have to see how this plays out. But let me step back and respond to another statement you said. Let me just reiterate, 75% of the global capital markets rested here in the United States. I would say that means the United States is fabulously successful when you have that. That being said, and I wrote this in my CEO letter that came out a week ago today, the biggest issue we have in capitalism, the biggest difference that we have today is we have not seen a broadening of the economy as much as we need to. And I think this is what President Trump is trying to do. How can we broaden the economy that we can have more opportunity for more? I mean, like I said, I think we need more schools that help men and women in the trades like electricians and other areas where we know we have a severe shortage right now. And the other thing I would say, if you look across the different manufacturing spectrum, there's a lot of job openings. My biggest issue is all of this, and this is where the market is not focusing on enough. All of this, in my mind, is much more inflationary than the market is expecting right now.
How much more inflationary?
Well, the market is talking about all the recessionary pressures, which obviously will mute down prices. But if all the tariffs, and I'm not saying they're going to be put into place, if all the tariffs would be put in place, almost so many items are going to be much more elevated.
More expensive.
Yes, more expensive. We have so many needs for jobs already, and we're at 4% unemployment. When I started in Wall Street in 1976, full employment was considered 6%. And, we reevaluated, and now we say maybe, what is full employment, 3 or 4? I don't know what if they even use that term anymore. But, we have shortages of workers, and we're going to have even more shortages of workers. And if you overlay a part of the reason why we had American exceptionalism 80 days ago, and AI, the need to build out infrastructure is just as great today. And my biggest fear as we roll out AI in the United States, building these data centers, building our electricity grids, building out America, building out our infrastructure, we don't have enough workers already. All this is going to lead to higher elevated wages, which is in some respect a good thing, but a lot of it is going to be elevated inflation. So this notion that the Federal Reserve is going to ease 4 times this year, I see zero chance of that. I mean, I'm much more worried that we could have an elevated inflation that's going to bring rates up much higher than they are today.
Zero chance of 4 or 5 Fed cuts, depending on what moment we're looking at futures prices, or zero chance of any cuts whatsoever.
That's not an unrealistic idea, and I think the Chairman Powell said that last week when he said we need to have more information. I don't see any reason to cut right now, and that's how I interpret his comments last week.
So you're concerned about inflation. You briefly mentioned
can I interrupt? Excuse me.
Sure.
I'm concerned about inflation if all the proposed tariffs truly go into place. At the same time, you have, if the president is successful in changing the behaviors of other countries by bringing down the tariffs, we could actually, the end result could be lower tariffs across the board. And I think that's what when he talks about reciprocal tariffs, he's talking about, I'm going to match your tariffs, and if you bring them down, I'm going to bring them back down. And so there is some value to that. Our tariff system was founded post-World War II, post-Korean War, where we believe that if we could lift these other countries post these crises, American businesses would be the biggest beneficiary. And we have not changed how these asymmetric tariffs that we've created over the last 80 years. And, is there a value today to relook at how we have tariffs today and how to try to make it more symmetrical? Sure. And so we'll see how this all plays out. My former partner.
Ralph's lost time. So you've touched on this idea, Larry, that perhaps there's some justification for a change in.
I mean, look, I was with a senator today, and he talked about we import 29 million tons, which seems like a lot, of beef from Australia, and yet our beef cannot go to Australia. Okay, there's something that sounds like a legitimacy.
So that's one of the justifications that the president cites, right? Fairness.
Yeah.
Right? Other countries are, in his words, ripping us off. The second.
I'm not going to go talk about that.
Okay. The second is revenue. Taxing imports will raise trillions of dollars to pay down the federal debt.
At whose cost, though? No, that's never discussed.
And then there's a third, right? Yeah. Reindustrialization, that companies will bring jobs and factories back to America. Which of those, is that a package of arguments that makes sense?
I believe there are in some areas where we need to bring back manufacturing for national security areas. I don't think Barbie dolls is something that we're going to, or Swiss watches or anything like that we have to have, or shrimp from Vietnam. I mean, all these different things. There are some industries where having a more control of your supply chains is probably very important. So
you're making the case for a much more calibrated.
But that's who I am. I'm always a little more balanced in the center. Yes.
What about the theory that these retaliatory tariffs are part of a Nixonian grand strategy, like dropping the gold standard, was to solve America's debt problem by forcing down treasury yields and weakening the dollar. That's a theory that has some purchase right now.
Well, I do believe the dollar will be weakened. I mean, most political theory is, or economic theory is, tariffs raise the value of the currency. I think it's going to weaken the dollar. Look, the one thing I would say with certain, the economy is weakening as we speak. And so the need for the administration to focus on these pro-growth agendas, which was much of what the president campaigned on, we have to get that going. Whatever it's the tax cut, we need to be deregulating, we need to be streamlining permitting, exactly all the things I've been writing about, where we need to get the private capital, private markets to start investing in the United States. We need to, and I think right now the market's not focusing on all these. We forgot about the power of AI, the power of all these different changes. We're focusing on the market, but the macro trends of AI, the macro trends of rebuilding our infrastructure, these macro, and if the president is successful in deregulating, if he's successful in streamlining permitting, then we could go back to this view that we have a major growth agenda in front of us. The president has been focusing on right now areas that, in my mind, in the short run, are very inflationary and destabilizing the economy, and that's what we've been talking about. But if we can find ways of rebuilding growth through these agendas, and then, as I said at the beginning, the market declines. We're going to look back and say this might be a good entry level to get back into the market.
Are we headed for a recession? Are we in a recession?
Most CEOs I talk to would say we are probably in a recession right now.
Right now.
A couple of airline CEOs told me. One CEO specifically said, the airline industry is like a proverbial bird in a coal mine, canary in the coal mine, and I was told that the canary is sick already. If you look at what's going on in air traffic and how people are changing and how so many people who, like Canadians, who are not coming to the United States, we're seeing in various different sectors a real downturn.
I have no doubt that people in this room and elsewhere are encouraged by this idea of yours that there are opportunities to seize. And it doesn't surprise me to hear you say that, because in the 16 years that we've known one another, you've always found a way to think constructively about the future, to make a case for taking risk, to make a case for staying invested.
Mm-hmm.
So explain that case right now. If, as you say, there's the possibility that at the very least equity prices continue to go down, mm-hmm. What should people do? Where are these opportunities? I can see why there might be opportunities for a firm like BlackRock, but what does everybody else do? Do you stay invested? Do you take risk? Do you take money off the table? What do you do?
Well, I would not be taking money off the table right here. I think that we've had enough, from the high water point of January, which may have been excessive. I think a rolling 1 year average, the S&P is down about 7% now. Could it be down? As I said, could it be down 17% from a rolling 1 year average? Sure, that would be about 40% from the high water mark.
That's a lot.
That's a lot, and it's a great entry level to get in, because I think the macro trends are not going to change. The need for the United States to rapidly build out AI is as imperative today as it was 3 months ago. Our need to invest in our infrastructure is as great as today as ever before. And so some of the big macro trends have not changed. The narrative that has changed. We're not talking about it, but I think if you spent time right now with the CEOs of the hyperscalers and the NVIDIA and other players, they would say the need is just as great today as it was 3 months ago. And I think some of the big macro trends are still in place.
Do you believe in a Trump put?
A who?
Trump put.
What is that?
If the markets weaken too much, that he'll reverse course on policy, tariffs, for example, or somehow engineer a combination of stimulative measures to bail them out.
That's what I said. I do believe the president is going to be focusing on these pro-growth agendas, and so we'll see how that offsets.
That's different, though. That's something that he's been promising the whole way along.
Correct. And so
Trump put would be effectively about the president getting scared.
I don't know how to value that.
Tariffs, Larry, are just one piece of a much more comprehensive policy agenda. Since the inauguration, we've seen major initiatives on everything from immigration and the border to rolling back DEI. I could go on, there's a lot. Most of it by executive order. Again, trying to take a step back from the burning question of tariffs, which are occupying the markets at the moment.
Right.
How would you evaluate these first 11 weeks of Trump 2.0?
A lot of volatility, a lot of change. And I think even before the tariffs, there was so much change, so much volatility. I think this is one of the reasons why even 4 or 5 weeks ago, most CEOs were telling me business is incrementally getting worse. I think whether it was a threat of tariffs, whether it's just all these changes, I think more and more people were pausing and slowing down consumption as we speak. And I think all of this is just going to slow down consumption. One interesting fact, and I wrote about this in my CEO letter this year, there was always this notion that Main Street was different than Wall Street. And we always, it was good political statements about, Wall Street is here and Main Street's here. Well, the reality is 62% of Americans now invest in equities. So the market impact is impacting Main Street. And so even before this market setback, you were starting to see more and more, I would say, trepidation by consumers more and more, slowing down their purchases, slowing down their vacation plans. And all of this, I would imagine now with the market setback, is going to freeze more and more consumption. And I think we're going to start seeing that really quickly. So I do believe in the coming months we're going to see more evidence of a slowdown in this economy.
And investors are going to have to continue pricing that in, whether that's an impact on economic growth, whether less consumption leads to.
But we're going to also see how companies navigate these tariffs. Are they going to navigate the tariffs by trying to jam it down the manufacturers and lowering prices? We've already heard a couple U.S. retailers going back to their place of manufacturing and telling them you got to lower your prices. So that's one point. One point is, are they going to absorb the tariffs in their margins? That's not good for the equity market. Or are they going to just pass it all the way on to the consumer and elevate prices? It's probably going to be a combination of all three. But until we see how this all plays out, and then two, how much of these tariffs are going to be actually implemented, we'll see. But I think most of America does not understand the extent of these tariffs. What is it? 86% of toys are manufactured in China. So there's a 67% cumulative tariffs now in China. So those are going to be expensive Barbie dolls.
They are.
But across the board, the tariffs across the board, everything we're talking about is just going to be, I'm not saying 100% is going to be passed on in terms of the final purchase price, but a lot of it's going to be passed in, and the cumulative effect of that. So just think about, there are more American jobs in the fabrication of steel and aluminum than there is in making steel and aluminum. So we now have these aluminum and steel tariffs in place. What does that impact in the demand of the fabricated products? So all these things have major ripple effects. So we have and this is why the market's down, because it just creates this vast amount of uncertainty how this will all play out.
And uncertainty means paralysis, right? In the boardroom, in the C-suite. For how long? How long? This is the question that management teams are asking themselves right now. How do we move forward? Well, is there a way to move forward yet, or as you say, do you have to wait and see?
I think in most cases you're going to have to wait and see. But look at if you're in a boardroom looking at acquiring a company, well, it's cheaper now, a lot cheaper now.
But you also may have less currency.
Okay, fine. But if you're doing 100% equity, it doesn't really matter. So I don't. It's not a binary decision. I don't think it's going to defer all these decisions. I mean, obviously, already we saw a number of IPOs pausing, and probably for a good reason. But it's not like it's over. We're going to reassess itself. Maybe some of these valuations of these companies that were going to go public are going to be down 20%. In the long run, if they have a vital, strong business proposition, their stock will be fine. Yes. So sell a little less secondary shares, sell all primary, and it really doesn't matter.
Larry, what are foreign leaders telling you about these big shifts in U.S. posture and policies?
Look, I saw a couple of foreign leaders last week in Europe. They're asking my opinion, so
I am too.
They're pretty shocked. They're questioning. They're also willing to think about, okay, where is there asymmetry in the trading agreements with the U.S. and is there means and ways that we could be managing this more successfully, that we can move forward. Some of them are going to be adapting. Some are going to be retaliatory, like what China did.
What do you think is the right approach? To stand up to President Trump like Mark Carney is doing in Canada and the Europeans might get around to doing, or be more non-confrontational like the UK or Mexico?
Well, I don't think Mark is being 100% confrontational. I mean, I think
he's talking a good game.
Look, everybody's job is to try to solve problems and try to move forward. If you truly believe in your country's situation that you got to be confrontational, see how that works. I don't think there's one shoe that fits all, and so I think we're all going to have to play this out right. Look, I do believe the issues that we had with Mexico were was less related to. In most trade, it had much more had to do with immigrants and fentanyl, and I think the government of Mexico has mitigated much of that in the short run. So we'll see how that all plays out. So that came to a better outcome for America too.
Will it be harder to operate as an American company outside the U.S.?
I'm hearing worries and concerns. But if whether the U.S. is put on a pedestal or knocked off a pedestal, each and every country, each and every company has a responsibility to prove every day that you're a fiduciary in each and every country. So if you were a company that was not proving each day that you're trying to be working on behalf of your clients in Italy, or on behalf of your clients in Korea or Australia or Canada or Mexico, you're not going to be serving your clients in the long run. And so, to me, this is why I started off this conversation today. We're in 106 different countries. We have offices in 36 countries. Our job is to prove every day that we are working on behalf of each and every client. And so of the $11+ trillion that we manage, zero is our money. Zero. So if we don't prove every day that we are working on behalf of each and every client and helping them, then we're going to fail anyway. Will there be some negative overhang? Maybe, but I don't believe that's going to be translating into I would say a direct impact on the future of our business.
There is obviously no small amount of risk in running afoul of the president. He has shown himself to be willing to inflict a lot of economic pain on his critics and his opponents. Do corporate leaders have to choose their words carefully?
I think corporate leaders have to choose their words carefully with every government. It doesn't matter who's in office. I think our job is to, as a leader of BlackRock, my job is to be working on behalf of each and every country as best as we can. Our job is to provide the best advice that you can. And when you can give advice that it's held in private. You can do it one-on-one or in a small group of people. Your job is to be earnest and forthright and not to BS anybody. And so I've made my career around not telling political leaders what they want to hear, but I've led my professional career in telling political leaders what I think they should hear.
When I used the term economic pain, I had one thing in mind. A lot of people, including many people here in this room, have been following the president's attacks on law firms affiliated with attorneys who prosecuted him. And some, including Paul Weiss and Skadden and Wilkie Farr, have cut deals to save their businesses. Others are fighting the president in court. What do you make of that use of presidential power?
Let's move on. I mean, I honestly,
I could rephrase. If the president threatened to bar BlackRock from federal business, like managing money for civil servants, which you do, and warned your clients they might lose federal contracts, how would you handle that?
I would look at what the issues are at large and what the administration is asking, and I would make a judgment on what is the value of that, and am I standing up to the principles that I tell every employee at the firm? Are we living those principles every day? Are we doing what we need to be doing, or is there something that in my past that we needed to mitigate? So I don't know the circumstances about any of the law firms. BlackRock has, our job is to be working on behalf of everybody. Last year, clients were awarded us $631 billion of new money. On Friday, we'll announce our first quarter. Our job is to prove every day that we're working for our asset owners. And so I could answer that question how I would play it.
You were at the White House last month to see the president after BlackRock clinched a multi-billion-dollar deal to buy the port operations from a Hong Kong company, CK Hutchison.
I'm glad you said Hong Kong.
It's important, right? That deal was important because it included two ports in Panama that the president had accused of being controlled by China. J.D. Vance was at this meeting. Mark Waltz was at this meeting. Elon Musk was at this meeting. What did you learn from them?
I'm not going to talk about the meeting. Let me just go back on the TikTok of the deal. Hutchison has been talking about for 2-3 years on the idea, possibly entertaining an idea of selling their ports. If you look at their stock price, their stock from our evaluation was trading at 30% of book. It was trading around a 26 billion market cap at that time, and they saw the valuation of the ports to be worth at least 22 billion of it, and they have many more enterprises within the whole complex. So they went out and spoke to dozens of different potential investors. Because of our acquisition of GIP, we already had a large position in ports, having over 50 ports alongside our partners, MSC, and their port business, TIL. And we coveted the opportunity of adding on the Hutchison's ports to the port business that we have on already. And all the who's who of New York private equity was bidding on it. Every major shipping company put a bid in it. And so this was a pretty sought after asset. And I believe our consortium with MSC and TIL just gave us an overwhelming position. And the one thing I would tell this audience, 100% of the investment was done as a profit opportunity on behalf of our investors. There was not a kernel of decision-making related to any geopolitical considerations at that time. That being said, once we started into an exclusive conversation in locking down the deal with the seller, I did reach out to members of both parties, not just one party. I did have conversations with the administration, and we had conversations with some of the countries where the ports were located. So we I don't think I would have done anything differently. We were trying to be a fiduciary in everything we were doing. Now, obviously, it became much larger because if you read 90%, maybe 100% of all the papers, it said BlackRock bought Panama. I mean,
it's not a done deal yet. The Chinese have raised some concerns. What happens now?
I think this is going to be a very interesting thing to watch for geopolitical purposes. China is just, China is going to be reviewing this. Just like every other M&A transaction, we would have to go to 50 different jurisdictions for anti-competitive reasons. In China, because one of the big users of all the ports, none of the ports were in China, that'll be one of the jurisdictions that will review the transaction. And so that's the only way actually China can stop it.
Well, is there a greater risk now because of last week's tariff announcement that it does actually move to block it from taking place?
Of course it can, but it's going to be 9 months of regulatory review. So we'll see how this all plays out. I'm actually pretty optimistic that we will find a solution because if you look at it, everything was done in the right order. It was not done politically, despite all the narrative. It was done.
A solution with or without the Panamanian ports?
I'm pretty confident it would be the Panamanian ports only represent 4 or 5% of the total valuation of the whole enterprise. There's 6 port concessions at the Suez Canal that no one has ever talked about. So I'm just going to give you, some of the color. I mean, the port of Rotterdam, the biggest port in Europe, is one of the concessions there. It's going to be reviewed as one transaction.
You're confident?
Yeah. As of the moment, yeah.
Is this kind of thing going to become a trend? Big ticket M&A, especially of critical infrastructure driven by geopolitical risks?
Well, let's be clear. 2 years ago, no one would even care about a port. It would have been on page 40 of financial press. I mean, there was a lot of port transactions in the last 2 years that no one cared about. Yeah, I think this is a new reality today that countries are going to be looking at all these different geopolitical issues. That being said, BlackRock last year announced 3 mergers. There were 3 acquisitions. 2 of them are closed. In the first 2, we were hung up by one jurisdiction for crazy reasons. The GIP deal was closed because one of the infrastructure assets they had. And our Preqin technology transaction was held up for 5 months by one jurisdiction. I mean, they both closed, and so it just requires conversation. And we're mostly through with the regulatory review with HPS, and we already said it should close early second quarter. Excuse me, this is early third quarter, or no, late second quarter. I got to get my quarters right. And we're on track, but. Yeah, I do believe there's going to be a little more review, but we saw that already in the last year. And
more review, yes, for sure. More activity?
More M&A activity?
Because of geopolitical risk.
Oh, no. If the geopolitical risk creates economic opportunities, yes. But M&A is not going to be because of geopolitical issues. It's because, if geopolitical issues creates opportunities, I think there are going to be more M&A opportunities as we deregulate.